Good morning, good afternoon. Welcome to our next webinar. My name is Michael Horn, Vice President here at Final Frontiers Foundation.
My name is Scott. Last name is Vigneri, and I will be presenting today.
All right, Scott, so what are we talking about today?
We're talking about OBBBA, the One Big Beautiful Bill Act, and the impact it's had on a lot of different things. We're going to cover a lot of ground in a relatively short amount of time and probably create more questions than answers, but we're going to do our best. And just make you aware of some things that are out there. And obviously, since we're talking about missions, one of our focuses is going to be on charitable planning and charitable giving and how that's impacted. But there's also some tax planning strategies that we'll briefly mention. And before we start, we are not attorneys. We are not CPAs or tax advisors. This is purely informational. And if any of this applies to you and you want to act upon it, then I would strongly urge you to get with your tax advisor and your attorney. So the One Big Beautiful Bill Act. Let me change there we go. Transforming charitable and tax planning strategies. This is a comprehensive analysis of the most significant tax code overhaul in several years. It has a very interesting name. OBBBA stands for One Big Beautiful Bill Act. And it does make some impact on charitable giving and tax planning. And so it's good to know and get a grasp of what's going on with it. So we'll move to the next page. And as I said, we are not attorneys or tax advisors. So the OBBBA was signed into law by President Trump on July 4th, which seems significant, July 4th, the 4th of July. And it is one of the most significant overhauls to the U.S. tax code in recent years. A lot of changes that fundamentally reshape both charitable giving and tax planning strategies for not just individuals, but for corporations and nonprofit organizations. So it covers a lot of ground. And it's crucial for donors and tax professionals and organizations, charitable organizations, as they navigate the new landscape. And it's a constant learning course because many things change over the years. In charitable planning, you've got to keep track of this change and that change, and then tax planning, you got to keep track of this change. And it changes from year to year. There's always something that changes. So, but this has the most in a long time. Enhanced non-itemizer benefits. Democratizing charitable deductions. One of the most notable provisions is the permanent expansion of charitable deductions for taxpayers who do not itemize their deductions. It used to be, if you itemized, you got good credits, but if you didn't itemize, you just got one little minimal thing. But they've adjusted that so you get a little more benefit if you don't itemize. The legislation does increase the charitable deduction limit for non-itemizers from $300 for single filers, $600 for joint, to $1,000 for single filers, and $2,000 for joint filers. So that's fairly significant. That is a big help. The change makes charitable giving more accessible to middle-income taxpayers who benefit from the standard deduction, but previously could not deduct charitable deductions. This enhancement addresses a long-standing concern in the charitable sector where the high standard deduction amounts established by the Tax Cuts and Jobs Act of 2017 reduced the number of taxpayers who could benefit from charitable deductions. So that's been a big change and a big help for a lot of people. Now there's also what they call the 0.5% floor challenge. It introduces a floor on charitable deductions for individuals, meaning taxpayers can only deduct charitable contributions that exceed 0.5% of their adjusted gross income. So what they give here, in one way, they kind of take it away, temper it. For example, a taxpayer with an AGI of $100,000 a year would need to contribute more than $500 to charity before any deduction becomes available. So if you make $200,000, then $1,000, so on and so forth. Timing is everything in many things. The 2025 opportunity window. There are things, and we're basically into October. This is September 26th, so we're only 4 days away. 3 months left for 2025, and there are still some things that can be done. So given these upcoming changes, 2025 may be a potentially strategic time to accelerate charitable giving. In the transition period leading up to the effective date provides a critical window for implementing strategies that maximize benefits under both current and future rules. Number one, calculate your adjusted gross income threshold. Determine the 0.5% AGI threshold to ensure charitable contributions exceed the floor for maximum benefit. Instead of giving $250, give $600 so you get the benefit, or $1,000 so you get the benefit, if you can afford it, of course. This calculation becomes the foundation for all charitable planning strategies. Number two, accelerate planned gifts. Consider moving planned charitable gifts into 2025 before new limitations take full effect, particularly for high-income donors who may face reduced benefits under the new rules. So to your question earlier, Michael, yes, the structure is there, and that's pretty much set, but there's going to be some fluidity and dynamism as we move forward, and it becomes more set, but they're adjusting things right now. So 2025, there are things that can still be done, very beneficial for this year, even more so than usual. Number three, evaluate professional guidance. Work with a tax professional to navigate the new complexities and optimize charitable giving strategies tailored to your specific financial situation. It is important to contact somebody that knows how to utilize the charitable benefits. Not every tax professional understands about charity. And many people think charity is just writing a check to somebody or throwing money in the pot or something like that. Charity, yes, charitable planning is a whole different ballgame. And charitable planning is tax planning. There are charitable benefits that can reduce your taxes. And we've talked about that many, many times over the past, and we're getting close to whatever, year and a half we've been doing these. It's been a while. So yes, work with somebody who understands not only the tax benefits, but can look at the charitable benefits. Because we are talking about missions here. That's what we're here for. We are talking about how to get the gospel out. But we're also talking about how to be tax smart about it and get the benefit that the IRS and Congress has set up for us. Why just give the money and not get any benefit out of it if it's there for you? Advanced charitable strategies for maximum impact. Bunching strategies. Concentrating multiple years of planned charitable deductions into alternating years to maximize deductions under current rules while exceeding the new 0.5% floor in future years. This approach can help donors maintain tax efficiency despite the new threshold requirements. Donor advised funds, we've talked about those in the past. These vehicles provide timing flexibility. It can allow donors to claim immediate deductions while distributing grants to charities over multiple years. This strategy becomes particularly valuable for managing the new AGI floor requirements. If you use a donor advised fund, you make a gift to what we call DAF or DAF. You make a gift to the DAF, and then you advise the DAF where you want that to go. You have to be very careful about which DAF you use, because sometimes they will not cooperate with what you want to do, especially when it comes to giving to missions. There are some funds out there that won't do it, and But wait, it's donor advised. Yes, but it is what it is. So be careful in your research and find a donor advised fund that will work with you, not take advantage of you and your funds. There's also been litigation, and not litigation in the past, but propositions in the past that people are just sitting on donor advised funds and not using them. They're just putting the money away. And the concept was they're supposed to use it. That has kind of gone to the wayside, but it could come back to life. Non-cash gift strategies. A mix of cash and non-cash gifts may lead to greater impact as the legislation introduces new complexities for itemizers. Strategic diversification of gift types can help optimize overall tax benefits. If you give cash, you can get up to 60% of your AGI. There's obviously restrictions. Whereas if you give non-cash, it's only 30%. And a blend, that's where you get a tax advisor to come in and help you with that. There's also, we've talked about charitable gift annuities in the past. That you can use that for non-cash gifts. There's also charitable remainder trust. There's also charitable lead trust. There's many, many different types of instruments out there that could be utilized. These strategies require careful planning and professional guidance to ensure compliance with the new regulations while maximizing charitable impact and tax benefits. Your first point is your CPA. I highly recommend finding a good CPA. Yes, I know there's lots of people out there that do their own taxes. But when it comes to charitable planning and taking advantage of some of these benefits, it's good to have somebody like a CPA. You could figure it out, and if you're comfortable with doing that, it's your money. But and you can save anywhere from a few $100 up to almost $1,000, depends on what a CPA would charge you in your situation. But I would encourage you to look for a CPA. SALT deduction changes and estate planning impact. But temporarily quadruples the state and local tax deduction to $40,000. This is very interesting here, starting in 2025, from $10,000 under the original Tax Cuts and Jobs Act. The change particularly benefits taxpayers in high tax states, but its interaction with charitable giving strategies creates new planning opportunities and challenges. A lot of people in California are pretty happy about this. It's a big help to them because California is one of the highest state taxes out there. The SALT limit will increase by 1% per year between 2026 and 29, providing some inflation protection, but creating a temporary window for enhanced deductions. However, high-income taxpayers may see limited benefits due to the phase down for taxpayers with modified AGI in excess of $500,000. Estate tax exemption extension. OBBBA eliminates the scheduled reduction in estate tax exemptions that was set to occur in January of 26. The current high exemption amounts standing at $13.99 million in 2025 will continue rather than reverting to an estimated $7 million per individual. So if you have an estate between you and your spouse of 30 million, you're right there because it's at 15 million now. But it was going to change. It was going to go down to 7 million, but they've raised it to 15 million. So that was a relief to a lot of people. So the new SALT cap is 40,000. The estate exemption is 13.9 million going up to 15, and then 8% endowment tax. Guidance for charitable organizations. The changes in OBBBA will have varied impacts on different types of charitable organizations requiring adaptive strategies and enhanced donor education initiatives. Donor education. Help donors. As a charitable organization, it is our responsibility to help donors understand how OBBBA affects their giving strategies and tax benefits. Organizations must proactively communicate these changes to maintain donor engagement and optimize gift planning. Plan giving adjustments. You started out 24 or 25 with a certain plan, but now things have changed, and it's important to sit down and either go over that yourself with somebody, or again, get with your CPA, your tax advisor, your attorney, whoever you utilize for planning, your financial advisor, CFP, whatever the case is. Revised plan giving strategies to account for reduced estate tax pressure and changed income tax incentives. The permanent estate tax exemption changes require fundamental strategy shifts. And campaign timing strategy. Consider accelerating major gift campaigns to take advantage of favorable transition timing before new limitations take full effect in 2026. Key impact areas. Smaller charities may see reduced small donations due to the 0.5% floor, while major gift organizations must adapt to changes in high-income donor incentives. Universities now face significant new endowment tax pressures. We're covering a lot of ground here, and some of it's a little bit complicated, and some of it applies to only large organizations. But it's good for us as individuals to understand how this is all working together and how it can impact us moving forward. Organizational impact and diversification strategies. Smaller charities, the 0.5% floor may reduce small donations, as noted earlier, potentially impacting grassroots organizations that rely on numerous smaller contributions. These organizations, therefore, must develop new strategies to encourage donors to exceed the threshold or bundle or bunch their giving. Major gift organizations. Changes to high-income donor incentives may require these organizations to develop new cultivation and stewardship strategies, focusing more on mission impact rather than tax benefits alone. And really, that's what it's all about. What is our mission? I am not giving to Final Frontiers for tax benefits. I'm giving to Final Frontiers for the mission, to get the gospel out. And then, oh, by the way, I get some tax benefits. I realize that there are many people out there, that is their number one thing, is reducing taxes as much as possible. But many times, a lot of people think charity is just giving money away. You have your choice. You can give it to the IRS, or you can give some of it to a charity that you have control, and you can determine where that money goes and what impact it has to the charity you designate. Because most of it, if it's going to go to taxes, you have no control over where that money goes. Once the IRS gets it, the government's going to put it where they want. Whereas if you do some charitable planning, you can help some organizations that mean something to you. Universities and large nonprofits. The increased endowment taxes will create additional operational pressures and may influence fundraising strategies. Organizations with large endowments must reassess spending policies and investment approaches. I don't know if many people are aware, but an endowment is a gift to a school, and the only way they can use that money is to use it to help students. And they can't just take the money out. And if people donate money, they have to use it for the students. There's a lot of restrictions on how they use it, and this is going to impact that. Looking forward, navigating the new charitable landscape. OBBBA introduces significant changes to the tax treatment of charitable contributions to both corporations and individuals, with the potential to reshape charitable giving strategies for donors and the nonprofit organizations that rely on their support. The legislation represents a complex balancing act between encouraging charitable giving through enhanced non-itemizer deductions while limiting benefits for high-income taxpayers through floors and caps. The democratization of giving. Enhanced non-itemizer deductions make charitable giving more accessible to middle-income taxpayers because they get a higher deductible amount. And it potentially can broaden the donor base for many organizations. We get a higher volume of people giving. Strategic complexity. New floors, caps, and limitations require sophisticated planning and professional guidance to navigate effectively while maximizing charitable impact. There has been talk in the industry about utilizing private equity and private credit in 401ks. And a lot of people are very up in arms about that, but because they think it's too risky. But I think that I think it's kind of a condescending attitude towards people, and that they're like sheep and they don't understand. Really, it is upon the advisor to educate them and help them and give them the information, and they can make their own decisions. You know, if you invest in private equity, there's this risk and that risk, but there's also this potential. What do you think? Do you want to do that? Instead of, no, this is too complicated. You won't understand it. There are people out there that can understand the complexity of what we're talking about here. And if you're comfortable with that, I'd go for it. But if it's more than you want to deal with, or it's just more complex than you want to deal with, I would recommend a CPA or an attorney and a CFP, a financial advisor, somebody that can help you walk through it. Adaptation adaptation requirements. Success in this new environment requires proactive planning, strategic timing, and close collaboration between donors, tax professionals, and charitable organizations. Many people look at tax time, it's a historical. They're looking at what happened, and then they're going to reduce their taxes that way. Whereas being proactive, you can plan ahead, and this is what we're going to do, and this is what will happen. And that's, you know, obviously income in many cases can fluctuate, but you can have certain tax plans. I just helped a company set up a defined benefit plan. They know what's going to happen. They know that they're going to get this amount of reduction in their taxes. But the owner has a bigger benefit by using a defined benefit plan. And he can walk away and retire a lot better shape than what he had been. There is still benefit to the employees, but the owner pays the rent, so to speak, pays the light bill, and pays the employees, pays the insurance. And many times owners walk away with less. So the defined benefit was a greater benefit for the owner. I don't know how I got on that. Success in the new environment does require proactive planning, like we said, strategic timing, and close collaboration between donors, tax professionals, and charitable organizations. There are many charitable organizations that have on staff people that can help you walk through the tax code and decide what's best for you. The long-term impact on charitable giving levels will depend largely on how donors and their advisors adapt to these new rules. It is hoped, obviously, that the expanded lower levels can help people give more, where you can go up to $2,000 for a couple instead of, what was it, $600 before? As the charitable sector adapts to these changes, organizations, donors alike must remain flexible and informed to continue advancing philanthropic goals while optimizing tax credits. Now, I get emails, multiple emails every day from different organizations. I get emails every day from tax planning organizations. I get emails every day from attorneys, organizations. I get emails every day from charitable organizations, and they're all working in examining how this is changing everything. And they're all working, believe it or not, we're all working together and for the benefit of you, the client, to help understand and get you the best impact for your situation. And so things have changed tremendously, and we're still wading through it and, figuring it out. The IRS is still going through it, and they issue updates and memorandums nearly every week, So it's an ongoing thing, but the structure is set, and many of the things are set in stone as much as legislative things can be set in stone. They're going to be around for a while, but the tweaks and adjustments are going to be ongoing. And so it is important to either get some kind of resource where you can get information and stay up to date if you want to do this on your own, so the change is coming, or engage again a CPA or an attorney or both in your financial planner. I think that was the last page. Is there another page?
Nope, that's it.
Okay. So that was a lot of ground to cover, and we kind of went very quickly. And I'm sure there's probably more questions than answers. But we're talking about taxes, so that goes without saying.
Yes, definitely a very interesting topic. One's still got a little fluctuating, but definitely nice to get an overview of what to think about and plan for the coming year.
Yes. And overall, for most people, there's a lot of benefits. And there's a few downsides. They got what they call the 237th rule, which is very complicated. And they're still talking about that one, but they're still working through that one. That is a very odd fraction, but
yes, lots of math going on here.
But again, we're talking about the IRS, so yeah, 237ths. That sounds neat.
Where did this number come from?
Yeah, there's some history to that. So, all right, any questions coming in?
Not at the moment, no. So we'll definitely have this one posted up. I'm sure we'll get some people interested in watching this. And if you do and have any questions, feel free to post in the comments on our YouTube channel or shoot us an email, and we can kind of get you answered and get you connected from there.
All right.
But thanks for joining us, and thank you, Scott, for giving us this great overview. And we'll see everybody hopefully next month.
All right. My pleasure.